Okay, so this week I decided I'm going to try to test live streaming this market update, but I didn't tell anybody about it, so right now there's nobody in here, which is what I would expect since I didn't mention it on Twitter or Discord or anywhere else. I'm just testing out live streaming on YouTube, which I've never done. It's something I may try in the future. We'll see how it goes. This is the Dunning-Kruger effect, and I think this is very applicable to trading. I think a lot of us have been up here before, and I've definitely been there before where I thought I knew everything, but all I really knew was like basic TA stuff that I read in some books that turns out most of that stuff is not useful. Some of it is, but a lot of it isn't. And then eventually you get down to here, and that's not a fun place to be at all because you realize, man, there's a lot of work to get somewhere up in here. But to get up here, I'm thinking is probably impossible, but that's, what everybody's striving to get to as a trader is somewhere up here. But I don't think it's really possible to get there. I'm probably somewhere in here, but who knows? This is all subjective, but I just think this is an interesting way to look at trader psychology. I get so many people that tell me, the market is definitely topped. How many times have I been told that by people and PMs over the years? Many, 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 many times. So I always wonder, are they at this level? Because a lot of times I think they probably are. And I'm not saying I'm great or anything. I'm probably closer to down here than what I think I am. That's just a thought, just something to think about. Getting into the actual market. First things I want to talk about are some things that potentially were warning a little bit before this little pullback we've had again here. VIX Term Structure again was in severe contango, pretty severe contango. That's been a pretty good warning sign. The vol complex, the options market in general, is where the best signals have come from for the last 2 years. So that's where I think the best work on refining edge can be. If you want to refine your edge, I would say study the vol market, study the options market, and in any kind of positioning type of data you can come up with in that market can be useful. And the market in severe contango just means that perhaps the vol market is too bullish. People are anticipating things to be too good in the future. This was something, I don't talk about this a lot, but smart money, dumb money confidence. Before this pullback, dumb money was the highest they had been since before the October pullback or the November pullback. And the excess return was 0% over the next 2 months, given where these two were aligned, smart money and dumb money. Sector correlations are also another thing, kind of like an advanced breadth metric that is pretty good and something that I'm really liking as well. I remade this indicator in TradingView. It's not quite exactly the same numbers, but I'm not sure exactly how to use this yet, other than extremes in price and extremes in correlations potentially give signals. Certainly, price holding up near all-time highs, price sort of flattening out, is pretty typical. We tend to get a lot of what you would call a poor high in auction market theory. You tend to get a lot of these, and we did get a good high, you would call it here, and potentially you got that as well on this one, but you get a lot of tops on the S&P 500, and I think it's largely due to options, where we'll just run into a high OI strike and just stall, and that's how we get a lot of tops these days. Is they're kind of a sideways grinding top with only a very, very small amount of excess. Anyways, you get kind of that flattening look with correlations really high or really low. It seems to potentially have some value. So we kind of flattened out here, correlations were really high. We flattened out here, correlations were really high. We pulled back in both cases. But in this case, we flattened out and correlations were extremely low. So you can almost look at that as like breadth when kind of like a breadth divergence sort of look. It's just a different way of looking at it. You can look at this code, US sector correlations, if you I've published this. Yeah, I've published this on TradingView. The code is open source. You can see how I calculated it. But basically, I took every combination of all the sectors for not just the S&P 500, but all sectors for the entire stock market, U.S. stock market, and I just looked at every possible combination of correlations between each of those sectors, and then took an average. I'm not sure how Tradewell calculates his, but that's how I calculated this one, and it came out fairly similar to his. So that was potentially warning something. I don't know exactly. Hi. Yeah, I'm testing out the live stream, so I didn't really warn anybody that I was doing this. So if you popped in and say hi and hi. I am planning on editing this and uploading it later as well. But I'm testing out live streaming first. Maybe in the future I may do some live streams. As of now, this is just kind of a test though. Another thing I was warning ahead of time is the option speculation index got pretty extreme again, and it's been somewhat inconsistent in the past, but I think more often when we get above 1.5 now going forward, because I do think, as I've said already, I think the market's going to continue to get a little bit harder on the long side. Doesn't mean the bull market's over necessarily, but I do think there's a pretty good chance that the bull market is getting late, a little bit later in the tooth, or not necessarily late in the tooth, but it'll roll over and get slower. It's kind of, I think my base case is that, yes, we could still have a couple more years of up on the S&P 500, but probably not 10% plus or 20% plus like we've seen the last couple of years. I think we have 3 years in a row of over 10%, and 2 of those are, I think, we're above 20%. So, but again, looking at this now, it's getting back into the range, which has been a buy for much of the last 2 years, and I think in this case it's not necessarily different. I think it's probably still a buy. I just don't think it's a buy and hold for months on end necessarily like it has been the last 2 years. DIX is still moderately supportive, and there was a bounce on Friday, but Fridays are above average on DIX historically. I don't know the exact reason for that, but they are. FANG DIX is very weak compared to long-term historical averages. And what that means, I don't know. I think potentially with high valuations and with raising rates coming up, I think FANG could, I don't know that it necessarily crashes, but it may not be the leader. I think it might finally see value actually take the reins and lead. And if that does happen, as long as FANG doesn't completely shit the bed, then I think the market can still grind higher. It can still go up 5% next year and 5% in 2023. That's still on the table. My base case of range of outcomes for the next couple of years is your standard 5 to 7%, anywhere from that to a 2015-16 like sideways heavily volatility. I think we're somewhere in between those two is what we're going to see. I don't know exactly which one. So far, I got to lean towards more upside because I'm going to get into it, but a lot of the longer term metrics still are not bearish as we would probably see, as we would typically see before a more extended like cyclical bear period. And this is the value versus growth, and how many times have we seen value try to perform and then not? Is this finally the time? I think there's decent potential that value might actually outperform for a longer period of time here because of extremely high valuations and because of interest rate hikes. I think it's just going to be very hard for growth to continue leadership now. And if value can take over leadership, it could mean that the S&P 500 doesn't have a major bearish outcome. Remember earlier in the year when value outperformed, everybody thought, well, this means the S&P 500 is going to crash, but it didn't. S&P 500 went up, and then we switched back, and the S&P 500 also went up. No matter what happens, the S&P 500 has a tendency to win. So, I don't know. Maybe that's the perma bull in me coming out. I don't know. Sentiment has cooled off a ton. This is another reason where I am at least short term still bullish, and I still think we're probably going to 5,000, maybe higher. People are definitely buying into the higher rates means crash logic. Tapering definitely doesn't mean crash. Higher rates could mean crash potentially. It doesn't have to though. The economy's still very strong. We're not seeing issues in the credit market yet. We'll get into all that. But this is another reason, especially B of A. I'm a big fan of B of A's bull bear indicator because it doesn't move really fast. It's not like the CNN, which can be 90 1 week and 30 the next. And the reason it's calibrated to do that, or B of A is not. So yeah, and it just gives cleaner signals. Insiders are buying again. This is another reason I'm short-term bullish, and I've been starting to buy this dip. Insiders, seasonally adjusted, are buying. Stock Grid, this is kind of an interesting website. There is all kinds of information on this website. StockGrid, I think .io is the website. This is another way to look at volatility. All this is SPY divided by VIX. And it also goes to show you that the way you look at the market doesn't have to be super complex. I see some incredibly complex ways to look at vol, but just something as simple as this, SPY divided by VIX. Where are we at right now? We're at 24.86. So we're somewhere, we have around a 61% probability of being positive. I don't know how many days forward that is though. Is that just one day? That's one day. 61% chance of being positive one day. 53% 2 day. 5 day 60%. 10 day 61%. And 20 day 3%. So it's not a huge edge, but we're getting pretty close to that level where the edge gets pretty big. That's one thing. It seems like VIX has not popped real aggressively yet, like it has in the past. On every single attempt to correct since March 2020, for the most part, we've seen pretty massive VIX spikes, and we really haven't seen that yet. So I think there's potential where we may head a bit lower on SPX until we get, a decent VIX spike, maybe up to 25 or so. That's certainly on the table. I've been starting to scale in, but so far pretty light on this dip. I was able to pay attention to all those things I mentioned earlier, unlike what I did before over here. And I was able to raise quite a bit of cash before this, so I'm sitting pretty good. My trading has improved. I've spent a couple of months just kind of not real active in social media and Discord and just working on my own trading, and that's been helpful. And the trading has improved. Like I said, not much of a VIX spike yet. So potentially, especially when we close near the lows on Friday, I think there's a decent probability at least 4650, maybe 4600. And then I think we'll probably get a pretty good VIX spike and then potentially set up for a low. This is another reason why I'm short-term bullish. This is the Sentiment Trader Equity Hedging Index. This is how it's calculated. And we're finally seeing some hedging. This didn't see any hedging activity for much of this rally, and it didn't matter, but lately it seemed like that lack of hedging has mattered more. We're starting to see pretty significant hedging now. So this is another reason why I'm short-term bullish here, and I'm starting to scale into this dip. SPY social sentiment, this Twitter sentiment from Sentiment Trader as well. It got kind of extreme where people were really aggressively buying this dip, but finally getting some less bullish sentiment, which is bullish typically. And yeah, starting to see pretty good volumes on the put side and the put call ratios. Liquidity Premium, this is another reason why I'm short-term bullish. Typically when the volume in SPY is much higher than the volume in the underlying, that's all this is. Typically when you see that, it's bullish historically. So that's aligned bullish here. Longer term bullish metrics, credit spreads are still very low, historically low. This only goes back to 2016, but it's the lowest it's ever been. Since then, probably the lowest in history. The only times, it's been lower a few times in this uptrend since March. I'm fairly confident we'll see some kind of spike in this. So if we get a pullback and you see a pretty massive spike in this, that's where, I will definitely start to shift my perspective quite a bit. But seeing credit spreads still very low here, for me, that's, I view that very positively still. The only issue is typically before major pullbacks, they're relatively low, right? But you do tend to get, not always, but you do tend to get some kind of increase in the spreads before the bigger volatility. You do get some warning typically from this. And so far, this is still aligned very bullish. The yield curve has not been moving in the correct direction since March of last year, but it is at least temporarily moving in the correct direction. And it still has a long ways to go to get to zero, to invert. Just looking at, if all you had was this to look at, you would still have to lean on the bull side until this inverts, historically. And you could say we probably have at least a year before inversion, unless there's a pretty major shift pretty rapidly. So in theory, we should be good for another year just based on yield curve. Doesn't mean that next year, I don't think next year is going to be 10% plus on S&P 500. I think it's going to be more around 5%. Anywhere from 5% to 0% would be my guess, somewhere in that range. I don't think it's going to be a super bullish year, but I don't necessarily think crash is coming either. I think it gets harder for bulls. I think there's going to be, sell setups will take less confluence than they have in the last 2 years. I think aggressively buying every dip may not work out like it has the last couple of years. I think we'll probably see some bigger dips more often than we saw these last couple of years. But I think we're not necessarily set up for a recession. There's not a lot of indicators aligned screaming recession yet. Getting there, moving in that direction, many of them are, but we're not there yet. Central bank balance sheet is still increasing. They started tapering in December, but you can barely even notice it yet. GDP rate of change, still well above the 12-month moving average. GDP is still increasing above average. So the economy is still doing pretty well despite all the headlines and negativity that's out there. Economy's still doing pretty good. There's 7 viewers in here now. I didn't even announce it anywhere. GDP projected for next year, according to this website, is 5.2%. I think GDP now is much lower, and most of the GDP predictions I've seen are quite a bit lower. But still, let's say it's somewhere between 2 and 5%. That's pretty good GDP growth. So it's hard to imagine that the stock market will have a very difficult time with GDP growth being above average. Earnings, projected earnings for 2022 from Yardini, and you can look at his track record. It's been fairly solid. They're still pretty good next year. It looks like Q2, Q3, potentially some weakening. And we'll have to see how Q4 aligns. Q4s are typically pretty good, historically. So if we get into like Q3 and the projections for Q4 are getting pretty weak, then yeah, maybe then. And especially if you see credit spreads ticking up, maybe then you want to get super cautious and work or thinking about like a 2018 repeat or something along those lines. M2 still growing above average. The 12-month rate of change on that is still way above the long-term average. This is another reason why this is another long-term bullish thing for me. The news cycle has been pretty negative since November of this year. And typically that's bullish longer term. I still think there's too many people predicting the end too soon yet again. But I think there's a lot of bulls predicting a melt up, and there's even a lot of bears predicting a melt up. I think melt up is kind of unlikely. Usually to get a melt up, I think they usually start with decent sentiment to begin with, and sentiment has deteriorated so much. I think it's going to be very hard to get the melt up going now. I think it's just slow grind higher to sideways, somewhere in that range. Like I said, I think that's the range that we're potentially looking at this year. Trading environment, basically. So stock picker environment, trading environment. More mean reversion, I think, is definitely on the table. This is a longer term bullish thing. I've talked about this before, but this is money market assets that are parked in money market funds still remain historically high. You could look at this a couple different ways. Some people will say, well, they're always really high before problem, but typically the peak is near the low. Look at where we peaked in 08 on that. So this is basically a sample size of 1. Money market assets at an all-time high, with the SPX also at an all-time high. It's kind of a unique thing, and this is what we've seen a lot with a lot of metrics. I could pull up hundreds of metrics that show just this is the only time we've ever seen this type thing. So what do you do with that? I don't know. I tend to lean towards this as bullish long term. Oh, hey, thanks, man. Thanks for joining. Just testing out the live streaming. Let's see how it goes. Now we're going to get into things that are like long-term bearish or headwinds now, and certainly valuations, even adjusted for rates, is something that I view as a long-term headwind now. Rates have been rising a lot the last few weeks. S&P 500 just barely off the highs. So this is a headwind. There's really no other way to look at this other than this is going to be something that should, at a minimum, put some brakes on this uptrend a little bit. This is another thing that I suppose I'm going to put this in the bearish category. I don't know exactly how to formulate this, I guess, but a lot of people look at this as like a canary in the coal mine indicator. So high yield growth bonds, corporate bonds, when they are rolling over and diverging from SPX, that's a canary in the coal mine. However, I mean, I could show you 1,000 different times where that happened and it didn't matter. There's so many negative divergences on this that didn't matter, but then there's a few that certainly did. So I don't know. I'm putting it in the bearish category, even though I don't know whether that should really be classified that way, to be honest. Three straight double-digit years. For me, I don't think we're in 1998. I don't think we're in 1952. In the 50s through like the 60s, 50 through 60, I think was like some of the best GDP growth the U.S. has ever seen. So yeah, stock market going up quite a bit makes a lot of sense. Then in 98, you had massive growth in the internet, and you had, well, not really, it was more hype than anything. The real growth didn't happen until later, but you had basically, politically, you had Reaganomics, and then you had Clinton kind of doubled down on Reaganomics, which was massive deregulation and huge corporate tax breaks. And that, while it might be not necessarily good for the people as a whole, it's great for the economy as a whole. And we saw massive economic growth. And we're not seeing massive economic growth now. We're seeing pretty good economic growth for the cycle we're in, but it's nothing like that. So I don't think we're in 52. I don't think we're in 98. I think we're more around this 2015 type time period. It's a similar post-QE environment after 2008. So the returns that year were not stellar at all. Like I said, I think our returns this year will be either anywhere from 2015 to like a 5 to 7% up, standard up year. I don't know exactly what. You just have to watch all the metrics that I show in these videos and I've showed in previous videos, and you have to make your own decisions. I only put out a video out like once a month. So if you're sitting around waiting for me to put out a video to make up your mind on what to do, that's not going to work. You have to have your own system and come up with your own decision-making processes. I use a lot of discretion, but I like to use quantifiable data as much as possible and backtest things. I'm putting this in the long-term bearish category. The COT dealers just continue to slowly get more and more short. Still not at some longer-term levels that have been a problem in the past, but definitely getting there. I think this is a headwind for stocks. Retail exposure from TD IMX. Yeah, it's a headwind. And I don't think it's a secret that retail have been pretty aggressive in this bull market. I don't know that it necessarily means the market will crash, but I think a lot of the retail heavy names, stocks that we've seen the last few years, probably something like 1960 to 1980, what Jan Croissant was alluding to. Yeah, there's a lot of heavy sideways, from in the 60s and 70s. Yeah, that's possible. I don't know if it'll be that long because the market moves faster these days. And the Fed is more proactive, I think, than they were in the past. But yeah, this is certainly possible. Anyways, the retail names, the Palantirs and the Snows and all these that people were so excited about. I'm curious. I have not looked at a Palantir chart in a while. Just curious what that looks like right now. Yeah, still not looking too good, is it? Yeah, I think like stocks like that. Let's say Palantir is a good company and does have a promising future. If that's the case, I think we're in a stage 4 decline. Like if you want to talk about like stage analysis, there's only a few like textbook trading methodologies out there that I think have value. A lot of them are difficult to backtest, but for me, it's just like Wyckoff is one that I tend to like, at least for index trading. Because, if you look at, well, I don't know if I want to get into that, but I'll get into that sometime, why I think Wyckoff kind of works on the S&P 500. A stage analysis on a stock like this, again, it's hard to backtest and those sort of like theories, but I think that theory does have some merit. Anyways, I look at a Palantir and I go, this is probably stage 4 decline. We need this to at least base sideways for a while in a stage 1, and then break out into stage 2. Typically is what you'd want to see. And so I wouldn't touch it until we see at least a sideways base on a lot of these stocks. I think a lot of these retail heavy stocks like Palantir and like Snow. Let's look at Snow. I look at Snow. You guys can't see this, I'm sorry, but I can pull it over, I guess. Yeah, Snow actually is okay, but it's starting to look like it's rolling into like a stage 3 potentially. But I don't know. I think a lot of these retail heavy stocks from 2020, early 21 continue to struggle this next year, and that's where I think things like this will have value. Let's see. JD says, thanks for that. I was thinking if we see. Yeah, if we see 4K or 3,800 below, Fed may change its stance, but if inflation takes longer to calm, they won't have a choice. Yeah, that's true. That's true. That, I mean, that is true. A lot of the inflation is supply chain issues, and if that alleviates, that'll help the Fed's case a little bit for not raising rates. But we'll see. I think they're going to have to raise rates because inflation's out of hand. Okay, we're back to the beginning. That's all I had, guys. Like I said, I was just testing out the live stream. I didn't really expect anybody to show up. But thanks for showing up anyways. I'm still going to edit this and re-upload it with the editing. I don't think... Oh, Ollie says, I don't think Omicron has been priced into the bond market at all. Up here, we're going to get hurt chasing a cyclical rally. Possibly. Yeah, I mean, my view is I don't think Omicron's a big deal, but I could be wrong. I could be wrong, for sure. All right, well, unless anybody else has some more questions, I'm going to end this and I'm going to edit it and re-upload it. I'll probably take the live... I don't know if I'm going to leave the live stream public or take it down. I'm not sure. Because it was just a test this first go around. Next week I'll probably announce it. Yeah, you just crashed the party, yeah. Yeah, I just wanted to test it out, but I appreciate you guys stopping by and got a couple likes and appreciate it. Appreciate it. We'll try to do it again sometime, and I'll actually announce it the next time I actually do it. So I'm going to end the stream now, and if you guys have any questions, just ask them in the comments. Appreciate you guys. See you.